Hello, fellow Rebel Capitalists. Hope you're well. I am back with my good buddy, Kenny McElroy, and we are going to do a deep dive into multi-family real estate and find out what on earth is happening. We all know what happened a couple years ago, and the stuff was really hitting the fan. We had a lot of the office buildings going down in value, and that was impacting the bank's balance sheet, therefore dollar liquidity and lending in the space. But now we've seen this trickle over into the multifamily space that's creating a lot of, let's say, disruption, problems. And then we have to find out where the opportunity is there and how that might impact the overall economy. So, Kenny, thanks a lot for coming back on, buddy.
My pleasure. Yeah, there's a lot that's changed since the last we talked.
Yeah, I know you just did a video on how and this always happens in real estate. It's why it changes so quickly. It's not like the stock market that goes down by 20% in 2 weeks and then straight back up 30%. It's, and I think one of the reasons why is because the sellers are always looking in the rear view mirror and the buyers are always looking through the windshield. Right.
Yeah.
I think that's what your last video is about, where the sellers are still living in 2021 trying to get those prices, and they don't understand that there's no chance and they're going to have to take a haircut.
Yeah. The sellers basically have no rearview mirrors at this point. Right.
Dive into that, Kenny, because
So I think
we're expecting,
there's a bunch of things happening. One is, I think everyone, if you go back a year ago, let's say, I think everyone generally believed that things were, rates were going to come down and the economy was going to kind of stabilize.
Right.
That was really the problem with the way people bought stuff, George, in 2021, 2022, 2023, was that it was all based on interest rates kind of staying where they were. So all things being equal, that's what everyone thought. Now, we definitely were going to have some new construction and supply added, but one of the massive components that underpinned all of this were when rates went up. And so rates went up not only for new construction, but for anybody that had debt that was not fixed.
Right. So these multifamily guys were having to roll this over at higher rates, and therefore it impacts their cash flow.
Yep.
A lot of them negative cash flow, and they're just trying to hold off until the Fed rate lowers rates, but then they don't, and then they get to a point where they have to fire sell.
Yeah, well, so in 24, you heard survive to 25, right? Well, that like that went over, and then now of course it hasn't really changed that much. I mean, obviously Trump's in office and he's obviously beating on Powell to try to get rates down, but I will tell you, it's not going to be that significant. A quarter point here, a quarter point there is not going to move the needle to what some of these people want. And so what happens in this space is there's things that are called rate caps, for example, and loan maturities, for example. And so when an interest rate needs to be renewed, then there's a rate cap that expires. And when the rate cap expires, it means it adjusts to a higher rate, higher mortgage payment, less cash flow. So it's very probable, and a lot of people came out of pocket to pay those, like in the first year, the second year, maybe after 6 months, depending on the term.
Just to kick the can down the road.
Yeah, and that's right. And by the way, we did that too. Like a lot of people, said, okay, this is a great project. Let's fund these rate caps. And by the way, the rate caps really jumped, because it's basically an insurance policy to buy down a rate for about like a year. Well, now they're like, like we don't know if rates are going to come back to where they were, which I have to agree with. And so now there's a lot of people stuck, especially on the new construction side, at these 8-9% construction debt, really expensive. And then also you've got 5-6-7% on the floating debt for all kinds of commercial real estate. And quite honestly, the GPs or the partnerships are just out of cash. They've cash called, they've gotten new people come in, they've squeezed down their GP interest, they've squeezed down their LP interest, which basically means they brought new money in to their capital stack. And they're looking and they're going, we don't know if now the juice is worth the squeeze, right? Do we really put more money in at this point? So I think what we have now is we have a reality check for a lot of folks, and they say the values are 30-40% off of what they were 2 or 3 years ago.
And this is for multifamily, to be clear.
Yeah,
not office.
mostly multifamily, and not just multifamily, but that's the world I'm in.
Yeah.
Anybody that has any kind of fixed rate is probably in pretty good shape. But anyone who has any kind of floating debt or a loan maturity is probably not. So, because cap rates, which kind of govern the pricing, as you know, are up as interest rates are up. Cap rates are up, which means values are down, which is not a bad thing unless you have a loan maturity.
So what maturity of treasury is tied to the interest rate that you guys in the multifamily space are exposed to?
Yeah,
is
so
it
we
the 2-year,
usually
the 10-year, where in the curve
the
is it?
10-year, LIBOR, yeah. So it's and there's some kind of a spread against that. Typically, most of our debt is Fannie or Freddie agency, but there's a lot of debt funds that had different rates, obviously all over the map, depending on the sponsor or the borrower.
So is it off of SOFR? Does that sound
Yeah.
right?
Oh yeah, absolutely.
Okay, so it is more of an overnight rate, where if it was the 10-year treasury, to your point, the Fed could drop by 100 basis points, and that might not impact the 10-year treasury. In fact, the last time they dropped by 100, the 10-year treasury went up by 100 basis points, not down. So people think that the Fed control, when the Fed drops rates, people think that all rates come down, and that often isn't the case. In fact, often it's the opposite.
Yeah, and the other thing that a lot of people miss is, let's say somebody bought a $10 million property 3 years ago. That property's worth $7 today, more than likely, based on the higher cap rate.
Right.
So, because less cash flow from the higher debt cost. So even if the loan matures, they probably got a $7 million loan, right? They had $3 million in equity, $7 million loan. So in a lot of cases, the commercial properties are really worth about what the loan is. In many cases, it's significantly less. So even if the rates do come down to the old rates, which I don't foresee happening, it's not going to matter, because they have to. They're going to lend 60 or 70% on the new value. So in that scenario, if the values went from 10 to 7, they're going to loan somewhere in the 4.5 to 5 range, which means there has to be another $2 million to come into the project just to keep it. But after they already lost the 3, so that's actually what's happening.
Wow. So how prevalent is this in the multifamily space? And is it more so location specific?
Oh, yeah, it's definitely location specific. There's a whole bunch of things, as you would imagine, that are going on. The first thing is just the migration change, from people, after, the coronavirus, right? Like, what I mean? Right. Like everybody moved around. Now, that doesn't sound like much, but it really moved the needle on areas that some areas just fell out, like San Francisco or Portland or Seattle, as an example. So those downtown core areas are big trouble. Now, a lot of them moved to the suburbs, but a lot of them moved to other places. And so where everybody moved was fairly significant. And from a rent, because more renters in an area with the existing amount of apartments just means that that's good for that area, bad for the area they moved out of. So that was a big one. And so then you also add the political risk, so call it rent control, or the politicians saying, rent caps. And then also they're coming after real estate owners in the form of property tax increases, and insurance costs are going up. So you got all these things going on. And it's very, very specific to the submarket, and states are acting very, very different. And some areas just, quite honestly, just got bubbled up. Even like Florida, for example. Florida was in a huge bubble as a result of a lot of people moving there, and it's deflating pretty rapidly right now.
I know it is on the single family side, but is it also on the multifamily side?
So
Florida?
not as much on the multifamily side, but what was hurting multifamily in Florida specifically and in the Gulf areas of Texas were insurance costs, because the hurricanes just annihilated trying to get insurance in Florida on multifamily. We're talking about doubled, tripled, and so again, rents aren't going up like that. And so when you look at it from an ownership standpoint, you basically saying, I don't think I'm going to invest in Florida anytime soon.
Yeah, because whether it's an increase in a mortgage rate or an increase in your insurance cost,
Doesn't matter.
The net result's the exact same, right?
Yeah,
Less
right.
cash flow.
Right. And rents are flat. So the interesting thing is we're in this weird time where a lot of people started building in 21, 22, when rates were low. Remember, I think inflation hit 9.1, I think in June of 22, I think it was. The Fed was kind of late to react, and they reacted, as in that second half of that year in 22 and then 23. And so everything kind of stopped. So anything that was kind of under construction at that point is actually hitting now. So as people are driving around and they're seeing these cranes in the airs, those started a couple of years ago. It takes years to build a project, and so that's hitting the market today. It's flooding. And so it's a really good time to be a renter. There's a lot of supply hitting. Rents are flat. There's lots of concessions. I think I told you that in downtown Phoenix, which you're intimately aware of, a lot of out-of-state builders, 4 months free on a 12-month lease down there right now. 4 months free.
Jeez.
That's as bad as I've ever seen it. The west side over there by the Cardinal Stadium, 3 months, 2 months free. Meanwhile, Tempe, Scottsdale, you're not going to have those kinds of concessions. So so when you put a big net over Phoenix, all submarkets are not equal, right?
Yeah. So do you see similar concessions in Texas and in Florida?
Yeah. In certain areas, certainly Miami, as what happens is people build in areas of high concentration or where they think, they need to be. So you and I would have known better. We would have never built multifamily down in downtown Phoenix, right? Because it's one of those destination markets. People go in and out for sporting events and things like that. I'm not saying people don't live down there, but it's not quite there yet for, the full walkability and all that. But yet people do it. And so, you're going to find that definitely happened. And that's exactly what happened in downtown Phoenix. And these are beautiful buildings, George. These are, multi-story, elevator, brand new, beautiful, great view, that kind of stuff. Really, really, really in big trouble. Those are still tied to construction loans. So all of those are still, yet to be cleaned up. And so when we actually get what we call mark to market, so let's say somebody's building a deal down there for $50 million. It's probably today worth 35 at stabilization. Okay, which it's not going to ever get. So it's basically not going to get refinanced.
What is stabilization, Kenny? Is that when the occupancy rate gets to a certain level?
In the 90s, yeah. So call it stabilized would be in the 90s, with stable expenses and cash flows, and then you can put a normal loan against it, right? Because the construction interest is more expensive than regular. So
you're saying it just won't get there because of the oversupply. They're never going to get up. Well, not never, but within the next 3 or 5 years, they're not going to get up to, let's just say 85% occupancy, because there's just not the demand versus the supply, because they just went hog wild during the
oversupplied. Yeah, they oversupplied a little submarket. Now that could be a heck of an opportunity, right? Also, right? So at the right time, you don't want to catch a falling knife, but so it's a market to watch. But I personally, what's going to fix it? People moving there, right? So that's the only way. You have to have a lot of tenants moving into that area to fill those up. Period. That's the only thing. And so everybody's competing for everyone else's tenant, which is why they got 4 months free. Well, I don't have to tell you, 4 months free is that's like 60% or something, which means that the property can't even pay its bills, right? Nor its mortgage, right? There's nothing that makes sense there financially. So those properties that are in high distress areas right now, they're overbuilt, are going to be incredible targets to acquire, probably 2-3 years from now. But they're not there yet. They have to be finished, number one. And whoever's holding the paper on that, right, the construction debt, they're in big trouble. And so
that was the next question. I mean, who's taking the haircut on that?
It just depends on who lent, right? So that still has a ways. But there's these little, that's this new construction. You also have the same kind of thing going on with, the value add floating rate deals, right? Those could have been 70s, 80s, 90s deals. And so you have those also maturing. And so as what we call mark to market, what will happen is they'll be repriced, and then you'll start to see pricing will start to come down on multifamily. It's already come down on multifamily. There's already trades going on. It's like the deal that you and I walked on, the one that we bought in Vegas. We bought that for easily $50,000 a unit below what it costs to build it today. Way below replacement cost, and it cash flows today. So you're going to start to see things like that more and more and more here all through the remaining 25 and definitely in 26. And that's going to disrupt in a good way, George. I personally, as a real estate investor, everything I own is going to be impacted. But if I'm selling tomorrow, it's a problem, but I'm not, right? Like I'm in this for the long game. So it having the apartment market readjust like this is very, very good if you're trying to acquire in this next year to 2 years, which is exactly what we're doing.
I mean, it's a great example of why free market capitalism works. But in order for it to work well, you have to not just have profit, but you have to have loss. And so what happens in a cycle is there's always going to be people that don't know what they're doing, or they get too greedy, or whatever you want to phrase it. But they just make bad decisions. And what happens is you have to allow those people to go bust, and you have to allow people to take haircuts, and you have to allow banks to fail and pension funds to not be able to meet their liabilities. And then what happens is the people that were prudent, not just the people, but the entities, the banks, and the other investors, then they take over the assets of the people who made mistakes, and then the system becomes stronger. But what we've done especially since 2008, is we haven't allowed that system to play out. We've come up and we've tried to bail out everyone, and as a result, you make the system weaker. And I wish the stock market and the banking system and the United States as a whole was more like the multifamily space, because it would be far better off over the long run.
Yeah. Well, and this is real money at risk, right? Like, these are real people that invested in real projects, typically accredited, but also on the debt side and on even in the equity side, these are life companies, these are pensions, these are real people that are investing money on behalf of others. And so, but the thing is what all it will do for most people, it'll show up in that quarterly statement that they hardly look at, and they go, oh, okay, I'm flat this year, or it wasn't meaningful. Because they have so many assets, it'll just be a loss somewhere in some big line of stuff that hopefully even out for them. But if you're
diversified,
yeah,
but I just wonder how that impacts the space moving forward from a supply side. You probably have this big, this whipsaw type of effect where you get way oversupplied, and then you get way undersupplied, because once bitten, twice shy, all the liquidity providers are like, no, there's, I just lost my ass over the last 2 years. There's no way I'm doing that again. You want money for apartment building? I don't think so. And so then it goes the complete opposite direction.
Well, yeah, and here's one I'll tee up for you. What's really, really interesting is this weak dollar. So traditionally, George, there's always been a pretty even flow of foreign investment, right? Like, it always takes a little bit of the edge off. It doesn't matter where it's from, right? We've had a lot of, back in the late 2000s, or 08, 9, 10, I was raising money out of Canada because our dollar was weak against their dollar. And so you start to see, but now, because of what Trump did with the tariffs and the disruption and all the stuff going on with the stability of the U.S. currency, we are actually seeing a big drop off in foreign investment. And that's, I think, typically that's always been kind of consistent year over year over year. But now I think people are saying, we're just going to pause and see what this new administration does.
Yeah. I mean, I think if the dollar gets low enough, it's going to entice those foreigners to come right back in because they're going to have way more purchasing power, similar to what you saw in 2010, 2011.
Yep.
But I think the majority of what's happening to the dollar currently over the last month or so is really interest rate differentials. So you've got the ECB at 2% roughly, and you have the Fed, and they were supposedly going to remain paused for even the rest of this year. So as the probability increases that the Fed's going to cut rates, then that's going to decrease the interest rate differential. So that should be a headwind for the dollar. And I think that's why you're seeing the dollar go down as you see the economic data become weaker. And then you also see interest rates going lower. It isn't necessarily, what you saw during the Trump tariffs, that was kind of a dollar off type thing, right? Where we're just divesting of dollar assets just till we wait and see what happens. But then the dollar bounced back up to like 101, and then it started to go down to where we are today, around 96.75 roughly. And I think the recent move down, which is relatively unprecedented, I think this is the lowest or the biggest down move in the dollar since 1973.
Yeah.
When you're just kind of comparing the same time frames. So, but my point there, though, is I think it isn't the last month of what we've seen. I don't think has anything to do with what Trump or the lack of confidence in dollar assets. I think it's more so just the market seeing, hey, the probability of the Fed cutting rates is probably increasing, and therefore that interest rate differential is probably going to decrease between the Fed and the ECB, and the Fed and the Bank of Japan. And therefore, that's kind of a tailwind to the euro or a headwind to the dollar. But there is kind of a self-equilibrating process there where if you get down to 90 or 85 on the DXY, now all of a sudden, if I'm that European investor, I'm looking at my euros going really, really far in the United States. And those U.S. assets become more attractive, especially if I can put my euros, change them into dollars, get a lot of dollars for my euros and give them to Kenny McElroy and have him invest them and get a 12 or 15% return. That makes a lot of sense. It makes even more sense, I guess is what I'm saying, when the DXY is at 85 versus 96.
Yeah, that's exactly what I did. And when the dollar hit parity with the Canadian dollar, I guess it was September of 2007, I went up and did a big fund out of Canada. We started buying real estate in the U.S. because of that exact issue. But to your point, when debt is sitting at, let's say, 6-7%, equity is higher, right? It requires because it's a riskier than debt because debt's tied to collateral. Mm-hmm. So, typically, what's happening is the pricing of equity is more. And so people expect more while these rates are high. And so that's a new one too, because you used to be able to raise money at 5, 6, 7% on the equity side, but there's no way equity is going to commit at 5 or 6% when debt is at 6 or 7%.
Or when you can buy a 10-year treasury at 4.3.
Yeah, right. Exactly right. With almost no risk.
Yeah. So how are rents overall? I mean, I know with your properties, you've got your finger on the pulse. They're pretty much flat. And just a reminder to the viewer, most of your properties are in Arizona. You got some in Texas.
Yeah. Nevada, Oklahoma. Yep.
Okay. So kind of that Southwest region. But what are you seeing with rents outside of your properties? Because your properties are more so like B and A. What's happening in the C class space and those types of neighborhood? And then what's happening where are you seeing rents decrease?
Yeah. So rents are definitely, it's definitely the renter's time, and rents are flat or decreasing in many markets, not all markets, but a lot of markets.
Mm-hmm.
And specifically where they've been overbuilt. So think of some markets in Dallas, Atlanta, definitely Phoenix, and some of the other core areas. You're going to see that. Now, the interesting thing, George, it's been that way for a good year, right? So it's no surprise. Should be no surprise for anyone. This last quarter, we actually saw a stabilization and an uptick. Now, it doesn't necessarily mean it's a trend yet, right? Like we have to wait. But again, not like I was mentioning earlier in downtown Phoenix or the West Side, let's say. But for the most part, I think the high price of housing, the high price of interest rates for a single family house has pushed more people to the rental side of the equation, and it's put pressure on the rental market positively if you're a landlord, but not in all cases in all markets, because there's still many markets where you can buy in the $200,000-$300,000 for a house, even in Texas, all over the place. The average price of a home in Texas is in the low 300s across the state. So still very affordable state. So that's still there, but I don't think that the worst is to come for rents. I think the renters have about another year, being able to be real choosy on where they want to go and have lots of choices. However, after 27, George, the numbers show the absorption will be over. We'll start to see higher occupancies again. And then, of course, in 27, 28, you're going to start to see it's going to be off to the races again for rent growth.
Supply because of this cycle that we've gone from oversupply, which creates the undersupply, which then will likely create the oversupply.
Yeah, that's right. Yeah, so that's why we're buying now. You want to buy when there's disruption. You want to buy when occupancies are low and concessions are high and marketing costs are high and all that stuff, because you're buying on call it fundamentals that are stressed today. That's when you buy. And then, right now we've got these headwinds all over the place. And then what'll happen is when the supply starts to dry up and housing affordability stays at what it is, and if interest rates come down and single family prices come down, then of course we'll have a shift back over from the rental side to the buyer side again. But I just don't foresee that happening, because the only thing that's going to really adjust the single family pricing is more single family. It's like you said that, the cure for high prices is high prices. I think we're starting to see that on the single family side. And what's happening is that it's pushing people over into the rental category that would not have normally been. My kids really well. They're both in their 20s. You think about it, they have to have upwards of $100,000 now to be able to buy a home, right? 50 to 100,000. That's the number, George. Remember, isn't that nuts?
That's how much their annual income needs to be, or that's how much they have to
have down saved? Payments. Yeah, they have to have a significant down payments, right?
Yeah. Another thing that's interesting is there's an argument that higher interest rates caused low supply in single family because it prevented people from selling their house and moving.
Correct.
They didn't want to buy that same house across the street. Now their mortgage payment's going to go up significantly. So if that is true, then and that's a big if, interest rates come down, you although it's counterintuitive, you could see the opposite, where lower interest rates create a lot more supply than we otherwise would have, because now all of a sudden these people can move to the home across the street and they can get a similar payment. So they're going to be incentivized to sell, where before they were incentivized to hold. And that could really have an impact on nominal prices. And I guess that could have an impact on rents as well. But then the other variable, obviously, is the economy, because that's going to impact incomes, which obviously very important for mortgage payments and rent payments.
Yeah. And I think what I always tell people is just take a look at the auto industry. What people always solve to a monthly payment, right?
Yeah, right.
That's what happens. I mean, and you and I both watched the auto industry go from 36 months to 48, 48 to 60, 60 to 72, 72 to 84, that they basically pushed the monthly payment out, got them into debt longer. Now that hasn't happened in single family, but I will tell you, they've been talking about it, 40-year mortgages and longer. And so that's essentially could be potentially on the table, because that is what people solve to. You know, a $3,000 mortgage payment versus a $4,000 is very different. And so a $3,000 mortgage payment means that people could probably start buying houses again, whereas at 4, a lot less. And so,
great point, Kenny. I mean, you have to ask yourself, why would they not do that? You know, I mean, even the Republicans we have right now, they're all central planners.
yep,
They're
very
all
possible.
they're all populists.
Yep.
So it to solve an affordability issue, why not just have Fannie and Freddie subsidize? I mean, the 30-year fixed rate mortgage is not a free market product at all. That's already a result of government subsidies or implicit guarantees. So why not just pump that up from 30 to 40? Like what's the downside there if you're a central planner? So that's
right.
great.
Yeah. And if that happens, then of course, then we'll start to see what you just said, right? Because that's what a lot of people solve to. And also, it's a huge number of people that refinanced are sitting in that 4% fixed interest rate. And so we're so far from that right now. We're not even close. And so there's all this trapped equity. The difference from now to from 2008, George, is that there's trillions of dollars of sitting in people's houses right now. Right. And there's a lot of people looking at that. How do we tap that? How do we get that money to start flowing? And I wouldn't be surprised if there's some new things that come out to be able to tap into that. If that happens, that will definitely disrupt the apartment, the renter, the landlord again. But right now, they're basically locked out. The prices are in the 400 range on the average, and the rates are in the 7% on the average. And so the difference between rent and mortgage is significant right now.
Yeah. I'd be curious to take a mortgage calculator. I don't know if you could get one that would have an input for a 40-year, but I'd be very curious to see what that would actually do to the monthly payment. Maybe I could go from 20 to 30.
Yeah.
Use that as a proxy to see how much that would lower the payment. Yeah, that the more I think about that, for the central planners and the politicians, the more problems that solves and the more votes that buys.
Yeah. Oh, yeah. Because people could use that because they want to move. I mean, you think about it. I have a ton of friends that have 200, 300, 400 grand sitting in their house, right? And that is everything they have, right? And they have this low payment.
Yeah, but it's on the refi side as well, Kenny, because if you're solving strictly to a monthly payment and the interest rate doesn't come down, but the payment does, because now you're able to refi at 40 years as opposed to 30 years, then you can extract that equity. And it's pretty much, the net result's the exact same.
It's win-win. Their lifestyle stays the same. Yeah, their payment stays the same. They get to scoop some equity tax-free because it's a cash out refi. So that would change the game quite a bit. It would help. It would really, really, put a nice shot in the arm to the economy.
Yeah, yeah, that would be a shot in the arm. I'm not sure if I would be in favor of that, because at some point you got to pay the fiddler, and also too, you just at the end of the day, wealth is just access to goods and services. So if we're increasing people's purchasing power momentarily, however you do that, it's even an increase in your job, your income, an increase due to your purchasing power for a cash out refi or a stimmy check. Unless you're increasing the amount of goods and services that are available to society at large, you're not making people any more wealthy, because the prices are just going to adjust higher. And so, the prices of homes would adjust higher. The price of stuff would just adjust higher. So the very first people to get those loans would be the beneficiaries. But after you go through this process, let's say 3 to 5 years, it's going to really, really disproportionately negatively impact the poor and middle class, the people that didn't have access to that credit.
And for those of might be listening, George, that go, oh my God, that'll never happen. That'll never happen. I already have one. We already are doing a 40-year amortization on a HUD deal, multifamily deal. It's
So
called
how
a
did,
two.
how did
It's
that
called
come
a
to fruition?
220. It's called a 221D4 loan, and
So
it's
this is
a
a new
construction
type
to
of
permanent.
this is like a
Yep.
new type of loan. When did this product come out, Kenny?
It's been around. We've used it a lot over the years, and it basically does exactly that. So it's a way for them to help a developer put housing in through a government sponsored debt, and it's a fantastic loan. It's called a 221D4, and it's a way to obviously lower your payment.
So why aren't the guys that got over their skis doing that?
Well, that's a new construction, ground up development, and not a lot of those folks understand how
Okay.
to do that. As you know, that's an area that we do. You know, we're builders. We develop from the ground up as well.
Okay.
So,
So the
but
value
there,
add guys don't have access to that.
right, and there are some other loans that actually HUD offers that can be used. Now, navigating the government, there's a heck of a lot of, you have to really, really understand how bureaucracy, lots of paperwork.
Yeah.
And you do need a team of people to help you get through it. But once you have them, they're great. They're market rate too, George. In other words, they're not restricted. I can rent to anyone. There's not a restriction like a low income restriction on the tenant side, which is one of the reasons we like it. It lets the free market do its thing, and so, but that does and is available today. So it wouldn't surprise me if more and more products came out similar to that.
Wow. So where do you think rents are going to be nationwide? I know it's all local, but nationwide, where do you think rents are headed over the next 12 months, over the next year?
12 months, I think it's pretty flat still. There are markets that you're going to see increases. There are markets that are, in a downfall, like I mentioned earlier. But nationwide, I think we could see 1% to 2%, maybe. I actually think this is it's gonna be very, very, very quick, and I think you got about a year. But then, George, toward the end of 26, you just look at the construction numbers; it drops off a cliff.
Yeah, right.
The supply drops off a cliff. So unless something happens in the next 18 months, 27 and 28 and 29 are going to be extremely good for landlords. And, it's going to be because of the lack of supply. It's not going to keep up with the demand.
Yeah. Yeah. And when I always think about this, I think about it in terms of the rents to income. It is true that the rents can only go so high before people just can't afford to pay it, regardless of what the supply is. So you just get more people per square foot.
Yep. Yeah. And
But
we've seen that San Francisco, Hawaii, New York, like people make do, like
yeah,
3 or
but
4 people in a $3 or $4 or $5,000 a month place. Yep.
what's interesting about the multifamily space, especially when you have apartment units in B and A neighborhoods, is although in aggregate total, you can have rents going up way faster than incomes to where a lot of people have to tap out. But you have those people that would have been a homeowner that have to now trade down and actually live in that apartment. So people kind of go down the economic totem pole.
Yep.
So the multifamily, an apartment complex, although you're in a good neighborhood, you're at the bottom of that totem pole. So people that would have been able to buy a $500,000 house, or just let's say a mid-range house or something like that, now they can't afford to do that. So they have to go into an apartment where the people that were in an apartment, they can no longer afford to be there. So they have to cram more people into the same space while you have those people coming down the economic totem pole that still need some place to live. And so that's why I've always like Hartman says, the starter homes or the apartments a lot more than I like, a higher end, like $1 million home and trying to Airbnb it or something like that.
Yeah. And I think you bring up another good point. There's almost no way to build affordably today. So,
right, right.
because of all the costs, right? Not obviously the actual physical costs of the lumber and the roofing and the appliances and flooring and all those things definitely make it a lot more expensive. But then now interest rates make it even more expensive because you have to finance it. So it's the same thing on the single family side. So I think back in the day, remember you could like build, oh, we're going to build entry level homes over here, right? Remember those days? That wasn't very long ago.
Yeah, I remember
And
in 2014, I built
yeah,
a new build for about 130 or $40 a square foot.
yeah. Right. Oh, so now you're right in a brand new property and a price point a lot of people can afford. So that has become increasingly difficult no matter what people say. It's so unfortunately, the only way to really build an apartment building today, George, has to be class A.
Yeah, because that's the only
That's
way the numbers pencil out, right?
Yep,
Yeah.
yep, and it's too bad because you can't. I mean, you just literally the cost is the cost is the cost, and then you just have to look at how much it's going to rent for, and if the math doesn't work, you don't even break ground. You can't break ground. You can't build something that is not going to rent. It's going to be subsidized. That's why the government has to come in with these tax credit deals and these abatement things both for the landlord and for the renter. That's the whole point. And so to your point, if you can find these deals below replacement costs, let's call it an 80s or a 90s or even early 2000, and you can buy these things at, 100, 200, 300 a unit. Let's say it doesn't matter if it's a standalone or an apartment, you're way below replacement costs.
Yeah, right.
And that to me, that's some of the best deal out there because you're always going to have affordability, especially where we're heading, I believe. And so, you lock that in with a fixed rate and that just like that deal you walked through, we bought it way below what it would cost to build. So we'll be fine over the long haul there. Right. And people should be thinking that way.
Yeah, over the next 10 years, I think it's a great time for landlords if they know what they're doing
Yep.
and if they're buying now at the right price to where you're still cash flow positive and your capital structure is prudent. But I think over the next 10 years for the poor middle class, the average American, they're just going to have to live in smaller spaces. I mean, I
Yep.
don't see any I don't see I don't see how you get around that. It's funny. I've got a buddy of mine from Vancouver, Canada, down in visiting in Medellin right now, and the prices up there. He was
Yeah.
telling me that
Crazy.
just a little teeny weeny like 2-bedroom apartments, like $2 million or something, just astronomical. And I've got him staying in one of my rental properties down here, which is about maybe 2,000 square feet, something like that. So it's a 3-bed, 3.5 bath, 2,000 square feet, call it. And when I let him in the front door, he walked around and he just could not believe how big it was.
Yeah.
And it's not, this is a 40-year-old guy. He's just like, it would be almost impossible to find a unit this big in Vancouver, Canada. And I think that's probably the direction that the housing market's going to go in the United States.
Right. So I grew up on the border of Vancouver. I used to go up there all the time. I watched this happen right before my eyes. And there's so many reasons that happened. And it's actually happening in Toronto. It's happening, in a lot of markets, supply constrained markets, certainly. But you're not wrong. I think the interesting thing is that we're at a fine line here because if you're in the game, in other words, if you own real estate today, you're going, as the economy hits and inflation comes, you're at least you're hedged, right? But if you're a renter, you're in trouble. I'll tell you, I told this story, George, and I can't believe I forgot about this story, but this is a true story. My dad passed away a little over 10 years ago, and I had to do this it's not. I never had to chat with my mom about expenses or how anything like that, but we had to dig in. So my dad, I remember saying he had this $10,000 insurance policy that he bought in the 60s, Also in the 60s, they bought their house, which my mom's still in, which was at the time $10,800. So pretty close, except one was an insurance policy and one was a house.
Yeah, right.
So my dad at the time was like, your mom's good. I got her covered. We bought her insurance policy. Well, he passes away, still 10 grand, right? The house is 700 grand. Yeah. And so my dad, essentially at the time, now I just want you to go back to the 60s and think about this. In my dad's mind, that insurance policy was worth a house.
Yeah.
And it didn't keep up with inflation. And I think, so that's kind of the point. If my mom would have rented, that's all she would have had was a $10,000 insurance policy. And I think that's the point. Yeah. So at some point you got to get into the game and get these hard assets and have somebody else pay it off. You pay it off, and I'm a landlord, but I'm saying, like, you got to own something that moves with inflation and moves with the economy. Yeah. Thankfully today my mom's got the home, which is not at all what my dad thought the strategy was, right?
Yeah, the key is you have to buy at the right price.
Yes,
buy at the right price, and you can't use too much leverage because then you're going to get yourself in the position of the people that are having to fire sell their properties right now to you. And so, in real estate, I always say that you never, even when you're going into a deal, the number one thing in your mind should be, how can I structure this deal to where I'm never, ever, ever going to be a motivated seller?
Yes.
And if you can do that, then that's, I think, the way forward. But so many people get into a property, whether it's multifamily or single family residential, where they're cash flow negative, and they're just putting themselves in a position where they very well could be a motivated seller if things don't pan out.
Yeah. And luckily my parents back in the day, I remember the day they both paid off the house. They were jumping around, dancing around the kitchen, that was back then, that was before the dollar was off the gold standard, all that stuff. Right. I'm not saying, but they, that's what they did. And so they didn't have any debt on that house for a long, long time. So they were in a very, very good position, but it's just interesting. Now that's all changed, right? They're like, how do we, and my mom, by the way, can you imagine this? There's all these sharks trying to do, you could do a reverse mortgage, and everybody's going after her equity, and I'm beating them all off over the years, and I'm like, no, you don't want any debt. You're on a fixed income, which is also another issue. My mom had a fixed income, and it's still the same. She's still got the same number. Luckily she's good because of the house, but I think I can't imagine that today they're going to be in any much different situation, when that day comes.
And it's so unfortunate because it forces people that lack sophistication. It forces them into becoming speculators.
Yeah,
just to maintain their purchasing power. Because although your mom's house is worth 700 grand now, it probably has the same purchasing power as it did when she bought it for 10.
Oh, for sure. Right? Yeah. I mean, I actually went back and looked. Yeah. It actually tracked inflation.
Appreciated a little bit. I'm probably exaggerating there. You probably could buy more stuff with 700,000 than you could 10,000 back then, but you get my point. It's not like it increased in purchasing power by $690,000.
Correct. It was the decline of the dollar.
Yeah, that's right. Kenny, talk to me about Limitless. What's going on? I know I'm
oh my gosh. Well,
I'm super excited about it. We got Kiyosaki, we got the usual suspects, and a lot of speakers that I don't think we had last year. So it's really, the event's just becoming bigger and bigger and bigger.
Yeah, I think, George, we kind of focus on a couple of things this year. One, we have a manufacturing panel. We have a tax panel. These are like, I wanted to find real people that are buying stuff from China and trying to do business. We have a tax panel, which, by that time, we'll see, is the big, beautiful bill going to be passed. And then there's a bunch of stuff in there, positive and negative, but that's going to be a fascinating panel. And then I pulled the heavyweights out this year, obviously, including you. We got Brent Johnson, obviously. We've got Jim Rickards. We've got Larry Lepard. We got you got Kiyosaki, we got Chris Martenson.
Snyder might be there as well. Is Snyder going?
Yeah, Jeff Snyder. Like it's gonna be. I tell you, people who want to try to figure out where everything's heading, because it's frustrating to try to understand that. I can't wait. We've had some good years, but this is going to be one of those years where I think a lot of people are scratching their heads on what to do and where are the opportunities, which is kind of where I'm trying to focus mostly, is what can we do in this new economy today, to take advantage of what I think we're going to have some tailwinds.
Yeah, I remember last year, RFK. That was so cool. That's something I'll remember for. Seriously, Kenny, that's something I'll remember forever.
Yeah. Well, you were a big part of that, George, getting him there and helping us connect the dots. And I would have never guessed that I would be interviewing RFK on stage. And I saw he came out yesterday with a bunch of stuff on the health. He's going after that, which is the right place to put him, the right chair for him. Boy, I think he's going to blow a lot of people's minds. I heard President Trump talking yesterday about autism, which I've been involved in for a long time, and I can't wait. If it's at that stage, maybe we'll get some people start looking at things like that.
Yeah, I think Trump may have autism, so it's something. All right. What's the website, Kenny?
It's limitlessexpo.com. It's in Dallas again at the Gaylord Texan, July 31st, August 1st, and August 2nd. And we, as you know, we typically sell out.
Yeah.
And we're gonna have 2,000 people again, and it's gonna be fun.
Yeah, very cool. All right, Kenny, thanks for your time, buddy. Can't wait to see you again.
As always, George.
I guess at the end of July.
Yeah, for sure. We'll see you in about a month.
All right, bye.
Cheers. Thanks, George.